Private credit risk can look quiet from the surface. Public spreads can look calm. Stock indexes can keep moving. The headlines can still say credit is orderly, but private credit does not trade on a public screen. The first clue is not always in spreads. Sometimes it is in the marks. Reuters reported that private credit funds had marked down more than a tenth of their loans by at least 50% in a market it described at roughly $3.5 trillion. That does not mean the whole market is collapsing, but it does mean the calm surface is not the whole story. So the question is simple. How big is this machine, and why can stress stay hidden inside it? Start with size. The Financial Stability Board estimates private credit lending at roughly $1.5 to $2 trillion. Reuters, using a broader market frame, cites about $3.5 trillion. Those numbers are not identical because they do not draw the same boundary. Private credit can mean direct lending, different fund structures, or the wider private debt universe. So the clean read is not, the market is exactly this large. The clean read is, different scopes, same message. Private credit is now too large to ignore. And once a market is that large, opacity is no longer a private inconvenience. It becomes a macro feature. A public bond gives you a price all the time. It may be noisy, but the market constantly tells you what investors think the bond is worth. Private credit works differently. The FSB warns that valuation practices and limited data transparency create challenges. It also notes that valuations are often less frequent and can involve significant discretion. That is the mechanism. The issue is not that every mark is fake. The issue is that the market sees less. Later, if a borrower weakens, a public bond can reprice almost immediately. A private loan may move through quarterly marks, manager estimates, and limited outside visibility. The FSB also points to payment-in-kind loans. PIK can be useful, but rising reliance on it can signal deteriorating credit, because interest is paid with debt instead of cash. Private credit can look stable for longer, not because risk is gone, but because the dashboard updates slowly. That is why the Reuters evidence matters. Reuters cited MSCI data showing that private credit funds had marked down more than a tenth of their loans by at least 50%. For smaller private debt funds, it said 13% of loans were valued below 50 cents on the dollar. A loan below 50 cents is not a mild wobble. Reuters described that level as typically associated with deep distress or restructuring risk. Keep the caveat attached. This is not the entire market. It is not every manager. It is not proof that all private credit is mispriced. But it is not nothing. Stress is showing first where data is thinner, funds are smaller, and the public market has less ability to watch in real time. Reuters said the write-down data came from the third quarter of 2025, and private credit performance often arrives with a lag. The marks can tell the truth, but they may tell it late. This is why public calm and private stress can coexist. On the surface, the market can look orderly. Underneath, some marks can already be moving lower. The contradiction is the point. Private credit can absorb stress quietly until the exit door matters. So what happens when investors want out? This is where the story is easy to overstate, so let's be precise. This is not a collapse case. It is a structure case. Look at BCRED, Blackstone's private credit fund. In its Q1 2026 shareholder letter, it reported $1.9 billion of gross inflows and repurchases of $3.2 billion. Outflows were larger than inflows, but the stabilizer matters. BCRED said it met all repurchase requests for the quarter. So the point is not BCRED is in trouble. The point is that even a large, high-quality vehicle has to manage an exit door. Golub's GCRED shows the gate mechanic clearly. Its letter describes a quarterly repurchase limit of 5%, but requests totaled 5%, so they were fulfilled pro rata. Again, not collapse. A liquidity window claim. If investors request more liquidity than the ordinary window allows, the fund does not have to fail for the exit to become crowded. It only follows the structure. The exit is not closed. It is narrow. Private credit is not sealed off from the rest of finance. The FDIC 2026 Risk Review says bank lending to non-depository financial institutions, or NDFI, has been a fast-growing loan segment. That category includes private credit funds and business development companies. The FDIC reports that NDFI loans grew 35.2% year-over-year in 2025. It adds a caveat. Some growth came from banks reclassifying loans under revised reporting instructions. So do not overread the number. But scale still matters. At the end of 2025, bank loans outstanding to NDFI totaled $1.4 trillion. The FDIC also warns that NDFI vulnerabilities can create direct and indirect risks, including liquidity demands at banks if NDFI draw on bank-funded lines during stress. This does not prove bank losses. It proves the transmission channel exists. Pressure can travel through credit lines before it appears in public market indicators. So here is the clean takeaway. Private credit is not automatically a crisis. And this is not a call that something must break tomorrow. The warning is narrower but more useful. First, watch valuation. Less frequent discretionary marks can make stress visible later than in public markets. Second, watch liquidity. Repurchase requests, gates, and prorated exits tell you whether the exit door is getting crowded. Third, watch transmission. Bank lending to NDFI does not equal losses, but it shows where liquidity pressure can travel. That is the lens. The risk is not that private credit must break tomorrow. The risk is that by the time stress is obvious, the exits may already be narrow. Hidden does not mean safe. It just means you have to know where to look.